Hello everybody, welcome to the DFT Lesson 6. Welcome to today's video where we break down the basics of the stock market. Whether you're a complete beginner or just looking to refresh your knowledge, we've got you covered. Let's dive right in. Now let's say, imagine you and a few friends decide to open a lemonade stand. You all contribute money to buy supplies and share the profits at the end of the day. The stock market works in a similar way but on a much larger scale. Companies, like your lemonade stand, need money to grow. They can raise this money by selling small ownership stakes in themselves, called shares. When you buy a bigger share of a company's stock, you become a part owner. The more shares you buy, the bigger your ownership stake and potentially your profits. These shares are traded on stock exchanges like the New York Stock Exchange, NYSE, or NASDAQ. Think of them as giant marketplaces where investors buy and sell company shares. The price of each share constantly changes based on few factors. First, the company's performance. If the company is doing well and making money, people are more likely to buy its shares. Therefore, the prices will go up. The overall mood of the market also plays a role. If investors are feeling optimistic, share prices tend to rise across the board. Even news headlines can affect stock prices. So, why would someone want to buy a share of a company? There are two main reasons. First, some companies share their profits with shareholders through dividends, which are like small cash payments. Second, investors hope that companies they invest in will become more successful, driving the share price up so they can sell their shares later for a profit. Now, let's look at the different types of stocks. Small cap stocks. These are the young guns of the stock market, smaller companies with exciting new ideas. They can be a gold mine if they take off, but they're riskier because they're less proven. They're just starting up. Investing in small cap stocks is like being an early supporter of a promising startup. It's a high risk, high reward. You really want to have done your research, everything, before you choose small cap stocks. Large cap stocks. Think of household names like Apple or Coca Cola. These are well established giants of the industry. They've been around for a long time, have a proven track record, and tend to be more stable. Investing in large cap stocks is like buying into a reliable brand with a lower risk of going bust. This means that they're stable, they're proven, therefore, it would be low to medium risk with medium to high reward. Mid cap stocks. These are companies on the rise. They're established, but not quite giants yet, like Apple. But there's but there are some like fast-growing tech firms. They offer a balance. Therefore, it's a medium. It's like a medium risk and a medium reward. So these are also proven to have a larger potential of growing than large cap stocks. Therefore, at some times, you might have a high reward or more reward compared to large cap stocks. Now you have growth stocks. These are like the race horses of the stock market. Companies with explosive growth potential, often new industries, their stock price is more sensitive to ups and downs because future expectations play a big role. So we are trying to see how we expect the stock will do in the future, which then affects whether the stock will go up or down. Now, what we're saying is it has high growth potential and it's volatile. When we say volatile, it means that it has sudden movements of going up and down. So it could be up 1 minute ago and the next minute it's all the way down. So these stocks are volatile. Now you have value stocks. Imagine a stock market treasure hunt. These are companies that seem to be undervalued by the market despite strong fundamentals. Value investors believe that the price will eventually catch up to the company's true worth. Value stocks are undervalued. Income stocks. Income stocks are like workhouses, providing a steady stream of income through dividends. Utility companies or established firms are good examples. Ideal for investors seeking regular income alongside potential price appreciation. So, income stocks are like your regular dividends. Now you have blue chip stocks. Now, these are like the creme de la creme, large, stable companies with a long history of success and reliable dividend payments. Think of companies like Johnson and Johnson or Procter and Gamble. They're known for their low risk and reliable returns. Now you have penny stocks. These are the underdogs of the market, trading for a very low price per share. They can be tempting due to the possibility of high returns, but they come with a significant risk. They're generally not recommended for beginner investors, so it's high risk, high reward. Now, IPO stocks, initial public offering. These are stocks of companies making their debut on the stock market through an initial public offering. IPOs can be exciting, but they're risky as well. The hype can drive the price up quickly, but it can also come crashing down if the company doesn't meet expectations. As usual, the stock market is high risk, high reward. Sorry, IPO stocks are high risk, high reward. Then you have ESG stocks. These are companies that will prioritize environmental and social responsibility, looking at their CSR, which is known as corporate social responsibility. If you care about a company's impact on the world, ESG stocks might be a good fit. Now, you want to invest in these because you are environmentally and socially responsible. Like, these are the companies I want to invest in. Now you have now there's two different types of markets. Now you have the bull market and you have the bear market. Now the stock market isn't always on a straight path. There are periods where everything seems to be on the rise, which is called as the bull market. This is where the market is going up, prices are going up, and everybody who's investing, so when they invested at, like, let's say $2 a stock, and after during the bull market period, that stock value grew to be around $10 a share. Now this is where an investor wants to be. They want to be in the bull market period. Economic news is positive, companies perform well, and the investor confidence is high. So investors, this is like the golden time. So, but on the other hand, you have bear markets. As usual, the stock market can't always go up, but it's not always a straight path. Sometimes it goes down. Just like sunshine isn't guaranteed every day, the stock market also experiences downturns. These are defined by sustainable decline in stock prices. Various factors can trigger a bear market, such as economic recessions or negative news events. So, bear market leads to declining stock prices and lower investor confidence. So, if I bought a stock which was previously like $10 per share and right now it's like $2 per share after the bear market period, this is where investor does not want to be because you're losing money. So, it's very important to choose which stock you want to invest in based on the market conditions, your research, and everything. So this is for part 1 of Article 6. We'll be looking at part 2 later on. Thank you for listening and thank you for watching as well, and hopefully you'll be ready for part 2.